about the GDP, that what is the gross domestic product, its definition, formula to calculate the GDP, and the types of the GDP. So first of all, whenever someone is hearing a news that an economist or a newspaper is talking about the size of an economy, when someone talks about the size of the economy, and they are most likely referring to the gross domestic product. So when someone talks that what is the size of the economy, then the person is talking about the GDP. So GDP is one of the most important statistics in the economics. Very important statistics, important factor which indicates the performance of any country. So measuring GDP tells us an enormous amount of how a nation is doing. When we measure the GDP of any country, it gives a clue, an idea that how the economy of a country is performing. So if the GDP is rising, it signifies that incomes are rising and consumers are purchasing more. All of this means a stronger economy. So whenever the GDP of any country is increasing, one can easily understand that the people, they are enjoying the better life, the better living standard. Not necessary that everyone is enjoying, but mostly people, the income of the people increase, so they are going to buy more goods and services. So let's start the discussion of the GDP. That the GDP, it measures the total value of all final goods and services produced within a country's borders during a period of time. So to understand that what is the gross domestic product, you need to understand few things. That this is the total output. Total output means each and every good or service produced during the given time period. Usually that given time period is 12 months. And in case of Pakistan, the financial year of Pakistan is starting from 1st July and ends at 30th June. So during that time period, how much a country is going to produce, and another term, that the final goods. GDP counts the final goods. It doesn't count the intermediate goods. Final goods are those goods which are ready for the consumption purpose. They are not going to be processed further. And other goods are intermediate goods, means the goods which we have to convert into the final good. When we talk about the wheat, it means is unfinished good. When we are talking about the cotton, it's unfinished or intermediate good. When we are talking about the wood and many other things. Sometimes the finished goods, intermediate goods, they are final goods, but in other cases they can be treated as the intermediate goods, like the milk. One can consume the milk, then it becomes the final goods. When someone is going to use the milk in the tea or the ice cream or coffee, then the milk becomes the intermediate good. And another term which is very important to understand that when we are talking about the GDP, that is the goods and services produced within the borders during a period of time. It means each and everything which is produced within that border, within the country's boundary line, whether the goods and services are produced by the people who are the citizen of that country or the foreigners who are working in that country. In our case, in Pakistan's case, there are many foreigners who are working here, like the Afghanis, the Chinese and the other national people. And Pakistanis are also working in different countries. So when we measure the GDP, we are not going to count the earnings of Pakistanis who are working in other countries. but we count the foreigners' earnings who are working here, the production in our country produced by those people. So GDP measures the total value of all final goods and services produced within a country's borders during a period of time. And it's not to be confused with the gross national GDP and the GNP. There is a bit difference between the GNP and the GDP. GNP means is the gross national product. It is the production of the people of that country, the citizen of that country, whether these people are working within the borders or they are earning outside the borders of the country. But in case of GDP, we only count the production which takes place within the borders of the country, regardless that who is producing. We does not include the earnings of the people who are working outside the country. So it is not to be confused with the gross national product or GNP, which takes into account the value of the goods produced by a country's residents, regardless of whether they live inside the country or abroad. So GDP is one of the most widely used tools to measure the country's economy, and it is calculated by countries themselves. GDP is measured quarterly by the Federal Bureau of Statistics or yearly by the Federal Bureau of Statistics. GDP is very important and very widely used term which is calculated by each and every country. And in the coming slide we are going to discuss the historical evolution of the GDP. The measurement of GDP is not very old. In the 19th century, first attempt to measure national income was made in England and France. They tried to measure the national income of their countries. By 19th century, only 9 countries computed national income. At that time, not every country was measuring the GDP. But due to the Great Depression of 1930s and the World War II, which increased the interest of the countries into the national income measurement. During the Great Depression, economists suggested the countries to measure their macroeconomic data, especially the Simon Kuznets and Richard Stones. Both economists received the Nobel Prize for their work on the national income accounting, that how to measure the national income of the country. So today all countries measure their national incomes. So after the Great Depression, most of the countries they have started to measure the GDP of their country. How we measure the GDP, or what is the formula used to measure the GDP? There are 3 major methods to measure the national income of the country, and they are different. Economists use the 3 different methods. The economists and the statistics, they use the 3 methods to calculate the economy of the country or country's GDP, and theoretically all 3 methods produce almost same figures with little bit variation or deviation. So these 3 methods are the expenditure method, income method, and the production method. Production method is also called the value added method. So number 1 is the expenditure method. This is the value of everything that is purchased within the countries plus the country's net exports to other countries. When we measure the GDP according to the expenditure method, the economists aid or measure all the expenditures incurred within the country, or the expenditure incurred on the purchase of the goods and services in a country, whether these goods are imported or whether these goods are locally produced. And in the coming slide, in the expenditure method, we add all the expenditures incurred during a given time period, the year. Whether it's a consumption expenditure, whether it's a investment expenditure, whether it's a government expenditure, and the net of the exports. And another method is the income method to measure the GDP. And in the income method, we add all incomes earned by the factors of production. And this is the income of all the individuals and businesses within the country, and also called the domestic income of the country. And the third method is the production method or production technique. This is the market value of everything that is produced within the country. The production method is that method which we call the evaluated method. This we add the value contributed by each and every stage of the production. So now we are going to discuss each method or each formula or each technique into detail. So how to calculate GDP based on the expenditures? This is one of the methods that we calculate the GDP, and this is calculated by using the formula GDP equal to consumption. C is the sign we are using for the consumption, plus the investment expenditure, R for the investment is the sign used, and plus G or the government spending, plus exports, X for the exports, minus the imports, M for the imports. So CIG plus minus X minus M. So the expenditure method is based on the idea that all the final goods and services produced in an economy must be purchased by someone. The goods and services which are coming to the market and these are purchased by the people, these are counted into the GDP. When we add all the expenditures, so the goods that remain unsold are accounted for as having been purchased by the producer. The stock or the remaining production is treated as the goods which are purchased by the producer himself or herself. So the consumption expenditure, investment expenditure, exports and imports. So let's talk in detail about each factor. Consumption makes up the largest part of the GDP calculation. In every country, the consumption expenditure is the largest portion of the GDP figure. This is anything a household or individual would spend money, like non-durable goods including clothing, food and so on, as well as things like rent. Note that the purchasing property is not included in the consumption. And in the consumption, the consumers, they buy the goods for their personal uses. They buy the non-durable goods, the goods which have the very short life, food items usually, and the durable goods, the luxurious goods are the goods which serve for the longer time periods, like bike, television, mobile. Then second factor of the expenditure is the investment expenditure. Is typically defined as an investment in new equipment or materials by a business. For example, a business buys new computers for all of its employees is the expenditure and is treated as an investment. Households purchasing property is included in investments. Since houses are purchased on loans, most houses will not pay all cash for property upfront. Housing investment is there, the capital investment is there, means the manufacturing sector is also expanding the size of the plants, and also the plazas are also constructed. Investments such as the purchasing of stock is not included in this definition of investment, and this is considered its saving. When people purchase the shares or the stocks, it is not counted into the investment, it is treated as the savings. Then the G or the government spending is one of the major factor, one of the major expenditure portion of the GDP. The sum of everything that government has purchased or spent money on. This means any physical product and the government has purchased, like fire trucks or aircrafts, carriers, investments that government has made, salaries of employees like teachers. This does not include any payment or programs such as welfare or social security, pensions, and these are not counted into this one. So, and also the exports are all goods that are produced within the country and sold to other countries. Imports are all the goods that are produced in other countries and sold to this country. Imports must be subtracted from the exports, otherwise foreign production would be counted as domestic supply. So government is spending, we say that the spending of the government from the local government to the federal government, and it is also one of the major expenditure counted into the GDP expenditure method. Exports, when we sell to the foreigners, these are the local goods, and when we import the goods, these are the foreign made goods. So we need to minus the exported items, imported items from the exported items. So exports will be added and imports will be subtracted from the expenditure. The second method of GDP measurement is the income method. GDP compensation of employees plus gross operating surplus plus gross fixed incomes plus taxes minus subsidies on production and imports. Compensation of employees is the total payment made to all employees or laborers. This also includes any welfare payments such as social security, means pensions, or any other payment made to the people without their contribution. Gross operating surplus is essentially the profit of incorporated businesses. Most large businesses with many employees are incorporated, means corporations' earnings. Gross mixed income is the profit of unincorporated businesses. Many small businesses are incorporated. So income is defined in various ways through the four factors of production. Labor and laborers earn wages, land earns income through rent, capital earns interest, entrepreneurs earn profit. So these are the different types of the incomes. When we add, it becomes the GDP according to the income method. And how to calculate the GDP based on the production or value added approach. This approach takes into account the value added to the entire domestic output. The value added is calculated by taking the price at which a seller is selling a product and subtracting that from the price at which the seller purchased the product from the supplier. In this method, we add the values added by each stage of production. If we say that farmer has produced the cotton, then the cotton purchased by the ginning mill or the cloth factory, they converted the cotton into the cloth, then they sell that cloth, and then the cloth is purchased by the tailor master, they convert that cloth into the shirts or the suits, and then they sell that cloth to the consumers. So the farmer has added value, the ginning mill or the cloth factory has added value, and the tailor master also added value to that production process. Which formula should be used, or one can say we need to use? So all three methods outlined above should arrive the same GDP. Whatever the method someone is going to use, the person will calculate the same GDP. However, there are often slight differences between them, which are usually caused by discrepancies in the statistics used to calculate them. There might be little discrepancies or differences due to some errors